Join our vibrant community of listeners who share, laugh, and grow together. Don't miss out. Hit subscribe and become part of the Banterloom family today.
All right, buckle up, everyone. We're diving deep into the world of stocks today. You want to make some serious cash, and we're going to break it all down.
And you know what's crazy? The stock market's average return is like 10% every year.
Seriously?
Yeah, way better than just letting your money sit in a regular savings account.
Okay, 10%. I'm listening.
Yeah.
So where do we even begin?
Yeah, NerdWallet lays it out in 5 steps.
5 steps. All right, I can handle that.
First things first, you gotta open an investment account.
Makes sense, but what kind are we talking about here?
It only takes like 15 minutes, it says.
15 minutes. Okay, that's doable.
So we're talking about a brokerage account.
Brokerage account.
There are actually a few different options depending on what you're aiming for.
Okay, so lay it on me.
If you've got a 401k at work, that's a great place to start, especially if your company matches what you put in.
Right, free money? Always good.
Then there's the Roth IRA and the traditional IRA. Those come with some pretty sweet tax advantages. And if you want to dive straight into investing, there's the regular brokerage account.
Got it, so account open check. What's step 2?
Step 2 is pick stock funds over individual stocks.
Isn't that playing it a bit safe? What if I want to be like the next Wolf of Wall Street, picking all the winning stocks?
I like the ambition. But hold on, let's talk about risk for a sec.
Okay, risk. Yeah, that's important.
Think of index funds like a giant buffet. You get to try a little bit of everything.
Buffet. Like where this is going.
Instead of putting all your eggs in one basket, you're spreading your money across hundreds of different companies.
So it's like diversifying my portfolio.
Exactly. It's way safer than betting everything on just 1 or 2 hot stocks.
Okay, so maybe less Wolf of Wall Street and more like chill investor on a yacht. But wouldn't I miss out on those huge gains by not picking individual stocks?
Well, picking individual stocks successfully, that's a whole other ball game. It takes tons of research. You got to really understand the market trends. And even then, there's no guarantee.
Yeah, that makes sense.
With an S&P 500 index fund, you're basically investing in the performance of 500 of the biggest companies in the U.S.
500 companies. Wow.
And historically speaking, that's been a pretty solid bet.
Okay, all right. You've convinced me. Diversification it is. What's next on our investing adventure?
This one's crucial. Patience. Step 3 is all about playing the long game.
A long game. Okay, I could be patient, I think.
We're talking buy and hold strategy here.
Buy and hold. Explain that to me.
Remember that 10% average annual return we talked about?
Yeah, that's sweet, sweet 10%.
Now imagine that compounding year after year. The longer you stay invested, the more that 10% can really make your money grow.
So it's like a snowball effect.
Exactly.
But what if, like, the market crashes? Shouldn't I sell everything before I lose it all?
Trying to time the market, even for the pros, it's almost impossible to get right consistently.
So you're saying I shouldn't try to be a market psychic?
It's more likely you'll miss out on gains by trying to jump in and out all the time. Remember, those short-term dips, they're normal.
So don't panic sell.
Exactly. What really matters is the overall upward trend over time.
Okay, stay calm and carry on investing. Got it. But what if I want to, actually see some cash flow from my investments, not just wait for them to grow?
I see where you're going with this. That brings us to step 4, dividend-paying stocks.
Dividends. I've heard of those, but break it down for me.
Imagine getting paid just for owning a little piece of your favorite company.
Wait, I get paid just for owning the stock.
That's dividends. It's how companies share their profits with their shareholders.
That's amazing.
And just like with index funds, you can diversify.
So I can get dividends from, like, a bunch of different companies.
Yep, you can invest in high dividend ETFs and get those sweet, sweet payments from multiple sources.
Okay, dividends are officially on my radar now. We've covered accounts, diversification, patience, and dividends. That's 4 steps down. What's the final step?
All right, step 5 is where things get really interesting. Exploring new industries.
Ooh, new industries. Now we're talking. But the market's always changing, right?
Exactly. It's constantly evolving with new sectors emerging all the time.
So how do I know where to look? What's a hot industry right now that I should be checking out?
Well, one that's really making waves is AI.
AI, artificial intelligence.
That's the one. It's disrupting pretty much everything, from healthcare to finance. The growth potential is huge.
Wow. AI. That's a little intimidating, to be honest.
Yeah, it's still early days, so there's definitely some risk involved.
So maybe I should dip my toes in first.
Yeah.
Like with an AI ETF or something.
Exactly. ETFs are a great way to get exposure to a specific sector without having to pick individual winners and losers.
Less risk, but still a chance to ride that AI wave. I like it. So ETFs are definitely something I'll be looking into.
Sounds good. Remember, research is key. Always do your due diligence before investing in anything new.
You got it.
It's all about finding what works for you and your investment goals.
Great advice. All right, we've covered a ton of ground today. I'm feeling much more confident about making some smart investment choices. Thanks for breaking it all down for me.
My pleasure. It's always exciting to see people get interested in investing.
I was a little intimidated at first, but you made it all seem so approachable.
That's what we're here for. Investing shouldn't be scary or confusing. It's about empowering yourself to take control of your financial future.
You know, I think I'm actually starting to get excited about this whole investing thing.
That's the spirit. Remember, the stock market can be a powerful tool for building wealth. It's all about having the right knowledge and the right mindset.
Right, and taking it one step at a time.
Exactly.
Awesome. Well, I think we've covered the essentials of making money in stocks, from opening an account to understanding index funds, dividends, and even debunking those pesky myths.
I think we did a pretty good job.
You definitely did.
Okay.
You don't need to be a Wall Street expert to make smart investment choices, that's for sure.
Absolutely. And remember, the key takeaways here are to think long-term.
Right.
Diversify your investments.
Don't put all your eggs in one basket.
And try to avoid making decisions based on your emotions.
Stay rational. Stay cool.
Exactly. The stock market can be a powerful tool for building wealth, but it's all about finding the right approach for you.
And don't forget, finding that right approach, it might take some time and some exploration.
Absolutely. Don't be afraid to ask questions.
Research, research, research.
And maybe even talk to a financial advisor if you need some extra guidance.
Great advice. Well, that wraps up our deep dive into making money in stocks. We hope you feel empowered to take control of your financial future.
We do.
And remember, the stock market is always evolving. Stay curious, stay informed, and most importantly, enjoy the journey.
Enjoy the ride.
Coming up next time on The Deep Dive, we're tackling a topic that's both fascinating and a little bit terrifying. The future of artificial intelligence.
AI, that's a big one.
Will it create a utopia or a dystopia? Join us as we explore the potential and the pitfalls of this rapidly advancing technology.
It'd be a wild ride.
Until then, happy investing. Okay, I'm feeling pretty pumped about this investing thing. But you know, NerdWallet also talks about these common investing myths that can really trip people up.
Yeah, even the most experienced investors can fall for these.
Exactly. So let's bust some of those myths, shall we?
Myth-busting time.
Let's do it. Hit me with myth number 1.
Waiting for the market to be safe.
Oh, classic.
It's such a common one. People sitting on the sidelines waiting for the perfect moment to jump in.
Totally been there. Like waiting for a sign from the universe or something.
Right, waiting for that guaranteed buy low signal.
Exactly. It's so tempting to try and time the market perfectly.
The thing is, you're up against human psychology with that one.
Oh, how so?
We're naturally wired to be more afraid of losing money than we are excited about making it.
Makes sense.
It's called loss aversion.
Loss aversion.
And it can really paralyze us, you know?
Hmm.
Keeps us from taking action.
So instead of making smart decisions, I end up just frozen, missing out on potential gains.
Exactly. And the market, it rarely gives you a clear, all safe sign.
It's unpredictable.
Totally. It's all about calculated risk and a long-term strategy.
Okay, myth busted. What's next on the list?
Myth number 2, buying back in when it's lower.
Okay, so this is all about trying to be a market genius, right? Timing those dips perfectly.
Yeah, thinking you can outsmart the market.
But that's easier said than done, I bet.
Oh, absolutely. Predicting those short-term market movements, it's pretty much impossible, even for the experts.
So you could end up buying high and selling low, which is like the opposite of what you want.
Yeah, that defeats the whole purpose. So how do we avoid falling into that trap?
Yeah, what's the strategy here?
Dollar cost averaging.
Dollar cost averaging.
Remember, Eliza Durana mentioned this in the article.
Yeah, she said a lot of people with 401ks are already doing it without even realizing it.
Exactly. Those regular contributions you make, that's a form of dollar cost averaging.
So break it down for me. How does it actually work?
Basically, you invest a fixed amount of money at regular intervals, no matter what the market is doing.
So whether it's up or down, I just keep investing the same amount.
Yep, that's the idea. It takes the emotion out of it.
Okay, I like that.
When the market's down, you buy more shares.
And when it's up, you buy fewer.
Exactly. Over time, it all averages out.
It's like a disciplined, no-nonsense approach to investing. I like it.
It is. It's a good reminder that consistency is key.
Way better than trying to be some kind of market wizard.
For sure. All right, ready for the final myth.
Maybe.
This one's subtle, but it can be a real portfolio killer. Selling out of boredom.
Selling out of boredom. Okay, I've definitely been guilty of that in other areas of my life, but not investing, thankfully. Explain this one.
So imagine you're watching your portfolio, and it's just kind of sitting there, not doing much.
No big wins, no big losses.
Exactly, just slow and steady growth. And then boredom sets in,
Ugh, I hate boredom.
and you start thinking, maybe I should shake things up a bit, chase those hot stocks everyone's talking about.
Oh, I see the danger there, like abandoning a perfectly good car just because it's not flashy enough.
That's a great analogy. Remember, building wealth, it's a marathon, not a sprint.
Right, slow and steady.
Exactly. Resist that urge to chase the excitement or jump ship when things feel a little dull.
Okay, so trust the process, stick to the plan, and let that 10% average return work its magic.
Got it.
But it's tough, you know? How do you stay disciplined and avoid those emotional traps?
That's the million-dollar question. One key is to really understand your own risk tolerance.
How much risk I'm comfortable with?
Exactly. And what are your investing goals? Are you in it for the long haul? Do you need regular income from your investments?
Those are good questions.
Answering those will help you make more rational decisions and avoid those impulsive moves.
So basically, before I even think about buying a single stock, I need to define my why.
Exactly. What's your overall strategy?
Makes sense.
And remember, investing, it's a journey. You learn as you go. Don't be afraid to seek advice, read books, keep educating yourself.
Great advice. Okay, I think we've officially covered all the essential steps to making money in stocks. From opening an account to debunking those myths, I feel like I'm well on my way to becoming a savvy investor. Man, we covered a lot of ground today. From opening an account to understanding index funds, dividends, even busting those myths. Wow.
It's been quite the journey.
Yeah, but you know what? I think the biggest takeaway for me is that you don't need to be some Wall Street hotshot to make smart investment choices.
That's so true. Anyone can do it.
Right. And it all comes down to thinking long term,
Long-term thinking, definitely.
diversifying your investments,
Thread that risk.
and most importantly, not letting your emotions drive the bus.
Keep a cool head. That's key.
Exactly. But hey, if anyone's feeling a little overwhelmed, don't worry.
It's totally
A
normal.
lot to take in. Remember, finding that right approach, it takes time and some exploration.
You don't have to figure it all out overnight.
Exactly. Don't be afraid to ask questions.
There are tons of resources out there.
Yeah, do your research. Maybe even talk to a financial advisor if you need a little extra guidance.
Absolutely. They can help you create a plan that fits your specific situation.
Great advice. Well, that wraps up our deep dive into making money in stocks.
And hopefully you're feeling a lot more confident about taking control of your financial future.
I know I am.
Me too.
And remember, the stock market's always changing, so stay curious, stay informed, and most importantly, enjoy the ride.
It's an exciting journey.
Next time on The Deep Dive, we're tackling a topic that's both fascinating and a little bit scary, the future of artificial intelligence.
Ooh, AI. That's a big one.
Will it create a utopia or a dystopia? Join us as we explore the potential and the pitfalls of this rapidly advancing technology.
Can't wait to dive into that one.
Until then, happy investing.